Hey guys, my name is Hashim and I'm the co-founder of Xynth. And today I'll be going through a strategy that basically helped me turn $10,000 into $60,000. And it's just one of the strategies that I've been using with Xynth in order to basically keep my portfolio consistently winning. So let's get into it. The first thing I want to look at here is IBRX. So if you look at IBRX, they got approved for their cancer drug Anktiva in mid-February of 2026. And after this, their stock essentially rallied 107%. Next, we have First Majestic Silver. They rallied around 40% after reporting a record-breaking quarterly 4 earnings result and also a dividend hike. This happened in mid-January of 2026. Now we have TMC, another company that rallied over 22% after their CFO warned short sellers on a podcast about something that was going to happen in the company. So now, what do all of these guys have in common? Well, they all have news catalysts. They all probably have some decent fundamentals. But that's not really what we're looking for. What we're actually looking for here is signs for institutional investing. So now we can see here that institutions dropped hundreds of thousands of dollars before the stock TMC rallied, right? And the same thing happened with AG. So here they dropped millions of dollars on AG before they reported their Q4 production and dividend hike, right? And for IBRX, the exact same thing. Now, how these guys knew these stocks were about to go up is not really important. What's actually important is the fact that all this data is actually publicly available for us to trade on. So what we can actually do is look up what these guys are trading and try to follow along in order to make us some money. So before we do that, I kind of want to explain what an options contract is, right? So if I pull up the SPY options chains here, let's go to here, right? What we'll see is that we have all of these rows of data, and each of these contracts here basically allows a person to bet on what price SPY is going to touch by what expiration date. So if I bet on this contract here, I'm basically betting on the fact that SPY is going to touch $510 by April 6th. And this will be a put. So a put is basically anytime you bet on a ticker going down. In this case, I'm betting the fact that SPY is going to go down to 510 from its current price of $656. And obviously we see here that there's no volume in this contract because this would be an absurd bet to make, right? Like SPY is not going to drop over $100 in 2 days. So now we can also bet on the stock going up, right? So we can have SPY going up to $691 by this date, and we can see that a lot of people are actually trading this contract because that's something that's very possible. So calls are basically you betting on the stock going up, puts are you betting on the stock going down. So now what is flow data? Flow data is essentially the data that tells us exactly where everybody's betting. So every one of these bets that we place in the stock market, whether it's from Jane Street, Citadel, these hedge funds, or it's from your next door neighbor, all has to be reported publicly. So now if we do a quick Google search for options flow data, we'll see that we have a couple of providers. I'll go to Unusual Whales, and here you'll get hit with thousands of rows of data, right? And this is basically every single person's bet in the market updating in live time. So each one of these pages here is, let's set it to 250, right? 250 results. And each row here basically tells us exactly how much money people are betting on what stock to go to what price by what date. For example, somebody bet $113,000 that Apple was going to touch $295 by April 10th. And you can see the last trade here was put in at 15.59, which is 3.59, right before the market closed, right? So each of these pages here is 250 different trades placed by different people on different tickers. Now, if we go to the next page, so that's 500 trades, that's 750 trades, that's 1,000 trades, right? And we can see that we're still on April 2nd. So in just a day, there's over 1,000 different flow data option points. So this data is, I think, safe to say, quite a lot to traverse through. And I'll show you how we can just kind of prompt our way through it now that we have AI. So I head over to Xynth and I'll essentially ask it, can you please pull up the ticker with the largest unidirectional flow? And this basically asks Xynth to essentially look through all this data, thousands and thousands of rows of data, to see which ticker has the most bets on it, whether it's in the call direction or in the puts direction. And we can see here that Xynth will be able to pull up this data for us by writing a bunch of code and basically searching through this data. So we can see here that Amazon has over $16.7 million in puts on it in the last week. ASTS has $18.2 million worth of calls on it. So we know that institutions are really bearish on Amazon, right? So should I go ahead and also buy puts for Amazon? Well, that's not exactly how it actually works. So if you do a quick Google search for which funds own the most amount of shares of Amazon. And we'll get here that Vanguard, BlackRock, State Street, all of these guys own billions and billions of dollars of shares of Amazon, right? And going back to the flow data and looking at Amazon as a ticker, we'll see that there's actually tons of, again, put flow, like how Xynth brought up, on Amazon. So why are these people betting $300,000, $600,000, right, against Amazon when they clearly own so many shares in Amazon? They wanted to go up, right? Well, actually, this is called hedging. So for a company like Vanguard, if they put billions of dollars into Amazon, they want to make sure that they're protected in the case that Amazon goes down. So if we look at the Amazon price chart, we can see that it's been quite volatile this past year. So in the case that Amazon goes through a period like this where it's going down, Vanguard doesn't really want to sell all their Amazon shares. Instead, they actually want to hedge themselves. So when Amazon goes down, the puts essentially even out the losses that they have from the shares of Amazon going down. So this type of flow data is basically called non-directional flow, where a hedge fund will sort of bet in the opposite direction of what they actually think the stock is going to do. So wherever they bet is not really indicative of where the stock is going to go. So here they have tons of puts on Amazon, but they actually own tons of shares of Amazon. So they're actually betting that Amazon's going to go up, right? So now how do we actually differentiate between the flow signals that we want to copy versus the flow signals we want to skip? To do this, we essentially have to go through a bunch of filters. And the first filter here is market cap. We want to filter by the market cap of the ticker that's being bet on. So here, I've basically told Xynth to go through all this flow data and look for the tickers with the largest premium. So we can see here that Tesla had over $30 million bet on it. Now, is that number really big? Well, Tesla's worth over $1.3 trillion, right? So a $30 million bet on Tesla is not really that significant just because the market cap's so big. Now you take that same bet, right? So around $30 million, sorry, and you place it on a company like FBIN, which is worth around $4.5 billion. Now that sort of matters a lot more because FBIN is almost 1,000 times smaller than Tesla, right? So to basically figure out which flow signals are actually significant, we're going to filter for stocks that are between $1 billion in market cap and $10 billion in market cap. So mid-cap stocks. And the second thing we want to filter for here is premium. Premium is basically how much money these guys are betting on the stock that they're betting on, right? So we can see here that somebody bet $3 on the fact that XSP was going to touch 672 by April 6th. So this is clearly a retail trader, right? And we don't really want to follow retail traders here. Not because they're stupid or anything, just because for the sake of the strategy, we're looking for institutional confirmation, right? So we're going to look for flow signals with a premium of above $30,000. So just to iterate, the first two filters on these flow signals are that the stock that they're betting on must be a mid-cap stock. So it must be around $1 billion to $10 billion in market cap, and the amount they're betting must be greater than 30,000. So now the next filter we have here has to do with IV, implied volatility. So IV is basically a metric assigned to every single stock in the stock market that basically tells you how stable the stock is going to be or how volatile it's going to be. But there's actually a caveat to this. So here I've told Xynth to pull up SNDK's price chart, and underneath it, it's implied volatility chart. So we can see that SNDK's implied volatility is relatively high for most of the year. So it's chilling around 100 to 120 almost the whole year. And this is because SNDK is quite volatile as a stock, right? So having an IV of 100 is very normal for SNDK. To actually see which stocks are actually truly volatile, we need to actually look at something called IV rank. So IV rank basically tells us how today's IV for this ticker ranks in comparison to the IV on the last 365 days for this ticker. So for example, if SNDK had an IV rank of 100, that means that today's IV for SNDK, it's higher than it's been for the last 365 days. And filtering for a high IV rank basically allows us to get stocks that are for sure to move. But now we have to figure out sort of which direction they're going to move in. And this takes us back to flow data. So for flow data, we want to look at stocks that have a 91% bullish flow versus a 9% bearish flow. So here what this basically means is that if you were to take all of SPX's flow signals and you were to group them by calls and puts, so how many people are betting on the fact that SPX is going to go up and how many people are betting on the fact that SPX is going to go down, and you were to compare them, we would want the calls to come out on top by 91% to a 9% ratio. And anything that doesn't fit this ratio, we filter out. So 91% and above, we keep. So if more than 91% of the bets on a certain ticker are in the bullish direction, we keep that ticker. Otherwise, we let it go. So here we're basically using IV rank to see which stocks are more likely to move, and then we're using flow data to see which direction they're more likely to move in. And that basically is the core of the strategy. So let's go back to an example. So TMC, that stock that I was talking about that jumped over 22% after the CFO went on a podcast to warn short sellers, their IV rank was sitting at 100%, and the flow was 78% bullish before the stock jumped up. Okay, so the last filter we have here is volume by open interest ratio. So volume basically tells us of all the bets that are going to a specific ticker, how many of those bets were made today, and open interest basically tells us how many of those bets were made all time. So if a stock has a high volume to open interest ratio, that means most of the people that were betting on the stock going in a certain direction basically came in to their positions today. Whereas if it has a low ratio, that means that there's actually high conviction there. People have been building this position for a while. And institutions usually have access to data that we don't have access to. So they usually know things are going to happen before they actually happen. So we're just basically looking for the highest conviction positions here. So now that we have all the filters ready, we're essentially ready to prompt Xynth. And to do this, we're going to head over to Xynth and basically give it a prompt that tells it to filter for all the criteria that we've talked about in this video so far. And this prompt is going to be linked in the video description below, so you guys are free to just go paste it in yourself. So it basically tells Xynth to screen for all institutional option flow alerts that follow all the filters that we talked about in this video. And I'm going to just hit send here. So after a bit, Xynth will basically write some code for us and search through the flow data that we were talking about here to find the flow alerts or the flow signals that have the exact criteria that we're talking about. And it will present us with something like this here. So we can see here that CUITK came out on top. It has an IV rank of 100, so our criteria was IV rank above 80, and it has a 100% bullish flow. So that means every single bet that was placed on CUITK was in the positive direction. And then we have a few more candidates like CA, Seabridge Gold, Fastly, and a car rental company. So before actually trading any of these tickers that Xynth surfaced, I want to ask it to basically do some background research on these tickers. And to do that, I'll paste in this prompt, which I've also linked in the description below. And it basically tells it to search through recent news, Twitter sentiment, analyst downgrades or upgrades, any red flags, and then at the end to give us a setup for the 3 highest conviction tickers. The entry I'm going to set at tomorrow's open, so Monday's open in this case, and a TP level of 20% and a 5-day timed exit. So we can see here that Xynth will be able to then basically search through news articles and also a bunch of tweets to basically tell us exactly which of the tickers it has the most conviction on. And for us, the final list seems to be, again, CUITK. And the reason why the IV rank is so high right now is because they're actually going through phase 3 clinical trials for their drug. And the trials are expected to release as early as this month. So this is a binary event. In the case that the trial goes well, the stock is going to basically rise. And in the case that it goes bad, the stock is going to go down. In this case, the bullish flow and the IV rank is basically telling us that the stock is actually going to go up after this event. And then Xynth will give you the entry and the take profit here as well. If I want to do more research on these tickers before I go in on them, which is quite often, since these are swing trades, I'm not really in a rush. I'll basically prompt Xynth to pull up more things about this company. So this basically does it for the strategy. Let's go through some results. So here we have our results. So this strategy was able to turn $10,000 into $60,000 in 7 months across 77 trades. And most importantly, it had a max drawdown of 15%. So if that's above your risk portfolio, you should not really be doing the strategy. And here we can see that the average win makes us around 3 times what a loss costs. So we can be wrong 1 in 3 times and still come out ahead. So just for some comparison, I've told Xynth to pull up the total return that NVIDIA gave us in the last 7 months and the total returns from SPY in the last 7 months as well. And we can see that NVIDIA returned 5.4%, SPY returned 1.1%, and their drawdowns were 9.1% for SPY and 20% for NVIDIA. Whereas for our strategy here, the drawdown was 15%. So somewhere in between these two for risk level, but then obviously greatly outperforming both of them in terms of returns. So that basically does it for the strategy. If you guys are interested in the trade diary that I have, where I basically wrote down every single trade that I took and whether it made me money or not, I can leave the link to this Excel sheet or Google sheet in the description below. If you're interested in more of these strategies that I've done with Xynth, and if you would like to see more videos about them, leave a comment, leave a like, and I'll be sure to get back to that. Thank you so much for watching.